Hey guys, Dave Keller here with Market Misbehavior. Hope you're all doing well. Market's certainly in distribution mode. We've talked about the markets being in what I call a digestion phase, which is more of a choppy sideways pattern where the markets continue to push higher, but the breadth conditions have been deteriorating. Now I would argue in the last week we're rotating to more of a distribution phase. We're starting to break key support levels, not just with broader S&P 500, but a lot of individual names as well, breaking down through moving averages, breaking down through support levels. Conditions are starting to worsen a little bit. So you're actually seeing the market follow through on some of the deteriorating breadth conditions. But what do I mean when I say deteriorating breadth conditions? Here we're going to talk about 3 examples of bearish breadth. So I always talk about the market conditions as being in order of priority: price, then breadth, then sentiment. Price tells you most of what you need to know, I would argue, right? If you know nothing else about the markets, focus on the price, the value of an index, the price of an individual stock or an ETF or a sector, because price should be an aggregate of all of the buying power, the selling pressure, the supply, the demand, the fear and greed. All of that should net out into the price of an asset. So tracking price, you're getting a good way there. Breadth is the way that you actually qualify what you're seeing with price. And what market breadth is basically looking at the names that make up a broader index. If the S&P 500 is doing a certain thing, what are the 500 names that comprise the S&P 500? What are those stocks doing? Because a lot of times at the end of a bull market phase, you will have the market doing one thing, but the breadth conditions will do something very different. And that tells you a lot of individual stocks and groups are actually starting to struggle before it's reflected in the major indexes. And that's a lot of times because at the end of a bull market phase, you have some of the larger, more defensive mega cap names that continue to do well. Enough of those are doing well enough that the indexes themselves start to continue higher, while a lot of individual stocks, particularly more the speculative names, higher beta names, things like small cap stocks and mid caps, traditional offensive sectors will start to rotate lower. And then the last thing that happens at the end is the market rolling over. Before we get to the 3 examples of bearish breadth conditions right now, I just want to remind you, if this sort of thinking about investor decision-making, technical analysis, behavioral finance, trend, momentum, breadth, sentiment, all of the above, if that's of interest to you, I hope you'll subscribe to my channel. It'd be great to have you along this ride with us. Also, give the video a like if you appreciate it. We would very much appreciate it back. Finally, put a comment below the video. What do you see with these breadth conditions? Do you think they are overall bearish or bullish, and why? Let's get to the charts. All right, so when we talk about breadth conditions, what you usually do is look at a chart of the S&P 500 or whatever index you're trying to understand, and then below there you have some breadth indications. And I'll talk you through 3 of these that we're going to look at, what they mean, what they're measuring, and why they've rotated from more of a bullish condition to a bearish condition. The first one, we're looking at the last year. We have the S&P 500 on a closing basis at the top, and we have the 50 and the 200-day moving averages. Now below here, these 4 red lines are the cumulative advanced decline lines. And here's what that means. Every day you can track the advancers and decliners in a particular bucket, right? It could be the S&P 500 or the mid cap index or the small cap index or a broader exchange like the New York Stock Exchange. Let me look at all those stocks and see how many have closed higher and how many have closed lower. That's called the advanced decline value, right? Or advancers, decliners is what most people call it. If you take those values every day and you start to add them together or subtract them and keep it cumulative and measure, it becomes the lines you see on the chart here, which are the cumulative advanced decline lines. So basically start the clock every day, add the net positive or negative advancers minus decliners, and keep a running total. For the most part, right, when the market is going higher, like the first 2/3 of this chart sort of play out, the market is making higher highs. You can see that these cumulative advanced decline lines are sloping higher, right? So they are all confirming the market is going higher and the breadth conditions are strong, right? As the market goes higher, it makes sense that more stocks are closing higher than lower on average, and that nets out to these lines going higher. But if you look at what's happened since June, July, August, September, you can see that the conditions have deteriorated. So when I talk about breadth deterioration, I'm looking May, June, July, August. Look how the market has gone to higher highs. But look how the advanced decline line using the New York Stock Exchange has actually been down, flat, and now once again breaking lower. So you have the index going higher, but the advancers decliners going down. Now, how is that possible that the index can keep going up and the breadth lines can go down? It's all a question of cap tiers and which stocks are actually going higher. If the biggest names, the FANG stocks, continue to do well, they're so big
that in a market cap weighted index like the S&P 500, the index can actually continue to push higher if there are enough names doing okay. So things like energy and materials and industrials and consumer staples and others can all be breaking down, but the largest companies are still doing okay. So the smaller companies breaking down doesn't really push the index lower, the index goes higher, and you have this breadth divergence where the market does one thing and the breadth does something different. What's interesting is if you look at the advanced decline line on the S&P 500, that's actually been confirming this uptrend the whole time. So the mid cap breadth went negative, the small cap breadth turned negative, the S&P breadth actually continued higher. But look what's happened in the last week. All four of these are now back below their 50-day moving average. All four of them have broken their most recent swing low from August. So while these lines are all red, this is actually a very subjectively color-coded chart. I color code them green, yellow, and red, like a stoplight, depending on the conditions that I see them. And in the last 24 hours, I rotated them all from green, amber colors down to red to confirm this breakdown in breadth. So overall, the trend has been somewhat negative with some of these since June, but now you're seeing all four of them rotate to a negative direction. That is very different than the previous pullbacks we've had in this cycle in 2021 so far. The second chart we're going to look at is this one, which is looking at the percent of stocks above their 200-day moving average and above their 50-day moving average. Now, here's a chart again, the last 2 years of the S&P 500. The 50-day moving average is in pink. The 200-day moving average is in red. Now, these are very simply the average of the last 50 closing prices, the average of the last 200 closing prices. And these are called moving averages because every day you move the window along. And so as a result, it sort of smooths out the price action, just gives you a long-term trend. I've recorded other videos on this channel on moving averages, particularly the 50-day moving average and why it's so important. So if you missed that, go check out those videos as well. So these breadth indicators are basically taking that idea, right? Is the S&P above its 50 and it's above its 200-day? So no, it's below its 50-day moving average, just broke below there on Monday, but it's still above its 200-day moving average, still above here. So that would actually be thumbs up on above the 200-day, thumbs down. It is not above the 50-day. You do that for all 500 members of the S&P 500, and this tells you what percent of stocks are a thumbs up above their 200-day moving average. You can see it's about 65, 66% as of today's close. In April, as the market was making a new all-time high, about 95+% of the S&P 500 stocks were above their 200-day moving average. So a full 30%, a full third of the S&P used to be above its 200-day moving average, and they're all now all below their 200-day moving average. The value we have now is the lowest we've had this entire year, and it's the lowest it's been since last October during this other previous corrective phase. So overall, the conditions are much less like these short-term pullbacks and more like a deeper correction in terms of price and or time. In terms of the 50-day moving average, it's just over 30% of S&P stocks that remain above their 50-day. I mentioned the S&P has broken down through its own 50-day. Most S&P members are also below their own 50-day moving average. This was up around 92% here in April. It's now down to 30%. So over 60% of the S&P members have broke down through their 50-day moving average. So overall, you can see the conditions are very different than some of the previous short-term pullbacks that we've had, where the S&P hits its 50-day and bounces higher. This is starting to look more like a deeper correction. Again, markets can correct in a number of different ways. Price and time are the two most common, and I would think about that both of those are possible. The final breadth indicator I'll show you is called the Bullish Percent Index. Now, this is using what are called point and figure charts, which is a series of X's and O's that track uptrends and downtrends. When a stock is making new highs or it's continuing to push in an uptrend, you have a column of X's. When it moves a certain amount against the trend, you move to a column of O's, and it basically tracks like on a grid, X's and O's, uptrends and downtrends. Very simplistic way that traders designed decades ago to track trends and do it in the pit and jot it down on little note cards. What this indicator does, called the Bullish Percent Index, says it tells you what percent of the S&P 500 are in a bullish pattern, have given a buy signal most recently from the point figure chart, versus how many are in a sell configuration. It's just above 50%. Right now, it's around 52% of S&P members that are in a bullish trend. So it's literally 50-50. Now, back here in April, it was around 85%. So about 35% of the S&P members have triggered a sell signal at some point in the last 6 months. In general, remaining below 70 is more characteristic of a bear market phase. So in June, July, August, when the market's pushing to new highs, and this indicator never really got above 70%, that's what's called a bear alert, where it's above 70%, goes below there, and overall that can indicate some deteriorating breadth. So there we go. We have three particular breadth indicators: the cumulative advanced decline lines, the bullish percent index, and the percent of stocks above their moving averages. All of them have been rotating, have been deteriorating for quite some time, but in the last week or two have really followed through and suggested that this time is indeed different.
So there you go. We've looked at three particular breadth indicators. And again, market breadth is a measure of participation. It tells you what individual stocks are doing that comprise the overall indexes. And you look at those patterns versus the chart of the overall S&P. The situation we've had in recent months is the S&P making new highs, the NASDAQ making new highs, while these breadth conditions were starting to roll over. The last week, we're really starting to see a bit of a pullback on a lot of individual stocks, and then the broader market as well, as you've seen these breadth conditions really deteriorate and accelerate to the downside. We're now starting to appear less like a short-term pullback to the 50-day moving average before the resumption of the uptrend, and more like this might be a meteor, more long and drawn-out correction in terms of price and or time. If this sort of thinking about charting, technical analysis, behavioral finance, trend, momentum, breadth, sentiment is of interest to you, I hope you'll subscribe to my channel. It'd be great to have you along this journey with us. Also, if you like the video, give it a thumbs up. We would very much appreciate that back. Finally, put a comment below the video. Do you agree with my assessment that the breadth conditions have deteriorated to the point that conditions are starting to look more likely to a deeper correction in price and or time? Do you agree with that or not? Let me know in the comments below. From everyone at Market Misbehavior, I'm Dave Keller. Be well and stay safe. We'll talk to you again soon.